What if a single flower could cost more than a house? What if a website with no profit could be worth billions? What if homes meant for living became tools of speculation? History proves one thing again and again. When human greed meets easy money, reality collapses. These moments are called economic bubbles, and they have the power to reshape nations, destroy wealth, and expose the psychology of markets. An economic bubble forms when the price of an asset rises far beyond its real value, driven not by fundamentals, but by speculation, emotion, and herd mentality. People stop asking what something is worth and start asking how much higher it can go. Every bubble follows a similar pattern: excitement, rapid price growth, blind optimism, denial, panic, and finally collapse. To understand how dangerous bubbles can be, we must explore three of the most famous examples in history: Tulip Mania, the Dotcom Bubble, and the housing bubble. The first recorded economic bubble occurred in the Dutch Republic during the 1630s, and it involved something surprisingly simple: tulips. Tulips were exotic, beautiful, and rare in Europe at the time, and they became symbols of status and wealth. Certain rare bulbs developed unique color patterns caused by a virus, making them even more desirable. Demand exploded, and soon tulips were no longer flowers, they were investments. Prices rose rapidly. A single tulip bulb could cost as much as a luxury house in Amsterdam. People from all social classes began trading bulbs. Bakers, sailors, merchants, and nobles all believed prices would keep rising. Futures contracts were created, allowing people to buy and sell tulips they never physically owned. The market detached completely from reality. Then suddenly, confidence vanished. Buyers stopped showing up at auctions. Prices collapsed almost overnight. Fortunes disappeared. Contracts became worthless. Although the Dutch economy survived, tulip mania became a timeless warning about speculative excess. It showed that when people believe prices will rise forever, even the most ordinary object can become dangerously overvalued. Centuries later, the same psychology returned in a new form: technology. In the late 1990s, the internet was transforming communication, business, and daily life. Investors believed the digital age would rewrite economic rules. Any company with a .com in its name attracted massive investment, regardless of profits or even revenue. Stock prices of internet companies skyrocketed. Startups with no clear business model were valued higher than established corporations. Traditional financial logic was dismissed. Analysts claimed profits no longer mattered. Growth was everything. Investors feared missing out and poured money into tech stocks. The Nasdaq index surged, driven by pure speculation. Companies spent heavily on marketing instead of building sustainable businesses. Venture capital flowed freely. But beneath the excitement, most firms were burning cash with no path to profitability. In 2000, reality struck. Interest rates rose, confidence faded, and investors began to question valuations. One by one, tech stocks collapsed. The Nasdaq lost nearly 80% of its value. Thousands of companies failed. Trillions of dollars vanished. Yet from the ashes, companies like Amazon and Google survived, proving that innovation was real, but speculation had gone too far. The dot-com bubble taught a crucial lesson. Technology can change the world, but it cannot escape economic fundamentals. Growth without profits is a promise, not a guarantee. The most devastating bubble of modern times was the housing bubble of the early 2000s. Unlike tulips or stocks, housing affects everyone because homes are tied to families, banks, and national economies. Low interest rates, easy credit, and government policies encouraged home ownership. Banks offered mortgages to people who could not afford them, believing housing prices would always rise. Financial institutions bundled risky mortgages into complex securities and sold them globally. Rating agencies labeled them safe. Investors trusted the system. Housing prices surged, creating the illusion of endless wealth. Homeowners borrowed against rising values, fueling consumption. But when interest rates increased, borrowers began to default. Housing prices fell. Mortgage securities collapsed. Banks failed. credit markets froze. In 2008, the global financial system came close to total collapse. Governments were forced to bail out banks to prevent economic disaster. Millions lost their homes, jobs, and savings. The crisis triggered a global recession, and its effects lasted for years. The housing bubble exposed how deeply interconnected financial systems had become and how dangerous unchecked leverage could be. Despite different eras and assets, all three bubbles share the same core elements. Excess liquidity fuels speculation. Herd behavior amplifies risk. Warnings are ignored. Regulators fall behind. And when reality returns, the damage spreads far beyond investors. Economic bubbles are not accidents. They're products of human psychology, optimism, fear, greed, and overconfidence. Markets are driven not only by data, but by emotion. Understanding bubbles helps societies design better regulations, improve financial literacy, and protect future generations from repeating the same mistakes. Today, new assets, cryptocurrencies, artificial intelligence, stocks, and digital platforms raise familiar questions. Are we witnessing innovation or another bubble forming? History does not repeat exactly, but it often rhymes. The story of economic bubbles reminds us that value cannot be created by belief alone. Markets can soar on dreams, but eventually they must land on reality. Those who forget this lesson risk learning it the hard way when the bubble bursts.